Hey guys, it's Tuesday, a rainy Tuesday here in Austin. Let's look at some earnings trades. We have some coming up after the bell. I believe SMCI, Dash, LYFT. Okay, so let's look at the earnings. So this is after the close. SMCI, Dash, LYFT. I showed you guys a trade in SMCI, but on Friday to put on for the weekend, but it was already up so much. I recommended you take it off. That one did well. All right, so let's look at maybe LYFT and Upstart and see if we can find anything that looks interesting to us. We'll look at Dash also. I believe I showed you guys a Dash trade yesterday because I thought yesterday was Tuesday. And anyway, so we'll see. We'll see how it's doing. But look at let's look at the chart of Dash. My strategies generally have to do with making the options just so outlandishly, setting the strikes where it's so outlandishly in my favor. If I'm bullish, moving the strike way lower, and bearish doing the opposite, that's my edge right there. I don't really pay attention to so much. I figure some are going to go up, some are going to go down, but my edge over time is going to be extracted by the option strategy itself. But that being said, if you have an idea which way the stock's going to go, that's all that much better. Just, I mean, obviously only do bullish option strategies on ones where you think the stock is going to have a bullish earnings and a bullish. It's not only what the earnings are going to say, it's how it's going to be accepted by the market. So we can see here back in August, they had earnings and the next day was a big up day, big gap up. Here, they had earnings and the next day was a big gap up, and then it finished down, but the morning was a gap up. Then they have earnings right here, and they haven't had them yet. These earnings are after the bell, of course. So will tomorrow be another big gap up for DoorDash? And the other ones are Upstart, the other big tech ones. Oh, no, I hit screener. Please don't go to screener. It did go to screener. I don't want to do that. Just go back to Upstart. Okay. Let's see if Upstart's chart looks as impressive as DoorDash. Jax is over there stretching out, just getting comfortable. He's been, we went for a walk down the street, but it was just between rainstorms. We barely had time to go potty. Okay. So look at this one. The last earnings report was uber bullish. The last two, but the one before that was the bearish one. So we'll see on this one as well, Upstart, and what was the other one? Dash, Upstart, and what was it? Dash, Upstart, and LYFT, of course. And I mean, there's Gilead. There's some other ones on here, but generally the bigger ones have the better volatility. I mean, the better liquidity on options and stuff. So I try to stick with the big tech ones. So SMCI, LYFT. So let's look at LYFT. Let's see how LYFT looks. LYFT and Uber both reporting. Okay. So let's see the past couple of earnings reports. This one was a big up day the next day. And this one was a gigantic up day is what it was. And on huge volume. It was a huge surprise. Okay, so I like this one the best. I mean, just the chart on this one. So let's go. I never used Tasty Trade enough, and I was just trying to use Tasty Trade to set up a trade on DoorDash, but I didn't really find much I liked. Let's look for a trade on LYFT. I'm going to look on Option Strat first, just because for me it's so much easier. But we'll look at it on Tasty Trade as well. All right, so let's see what we can do here. 130. Okay. Trying to see if we can get a good spread here, but it's on these low price ones. Sometimes these aren't great for the 3-leg strategy, but we're going to address that. All right, the 3-leg strategy makes $8, but it risks $292. We could scoot the strike in. Now we have an 11% buffer or 9% buffer. Makes $40 on 360. Okay, well, this will work. If you want to do a trade, I mean, this one is a cheap, fairly cheap way. Now let's put this one in. Let's put this one into Tasty Trade. But I'll say this for Option Strat. I can tell you right now that this, without even checking anything, I can visually tell you that this is a liquid stock and a good trade. And the reason I can visually tell you that is because I have the position set here to bid ask. See, that's in blue. On midpoint, you get a more favorable pricing structure. I always leave it set on bid ask, where you get the worst of the pricing structure. You don't split the difference. It just assumes that you get the total retail price. And if you can make a spread that still has good risk reward with the total retail price, then when you put it in a real platform like Tasty Trade, you should have the most. It should have the most leeway. It should be it's one metric I look at to tell me if it's a good strategy to play. If this was a bad stock, and I'm trying to make my point better why Option Strat is so good. That's what LYFT looks like. What's the name of a bad stock? A stock that has real illiquid options. I can't even. Nothing has illiquid options anymore. Nothing that I know of has illiquid options anymore. But let's just try to find one. But if you're messing with something that doesn't have liquid options, I'm going to choose one of these I've never heard of. I mean, BHF. All right, so on BHF, let's try to do the same trades on LYFT, and I bet it doesn't work out as well. Okay, well, one thing you can already tell they don't have weeklies because they have less expirations. But the other thing is they put this little warning sign on. That means there's a wide bid-ask spread, a 33% bid-ask spread. But my point is, if I tried to put on a spread in this, if I tried to do a bull put spread without even knowing anything else, just by the amount of green to the amount of red that's available, I can tell you this is unattractive. I mean, there's not one of these I would do just without ever getting into the tables or whatever. And the reason is because if you go to positions here, look on that 50 put, that 50 put, it's showing you buying it at 40 cents. Well, it's bid at 10 cents, asked at 40 cents. That's a huge disadvantage. And the other option only has a 10-cent spread on it. That's why anyway, my point is Option Strat is worth its weight in gold. It really is. So that's why I know as soon as I'm messing with something, as soon as I start messing with LYFT, I'm like, oh yeah, this has potential because of the amount of green area you can make versus red area. And you know, when you're putting on the put spread, you always start with the put spread. I was getting a lot of green for how much red I was getting visually, and then I was getting a pretty big buffer. Look at this, a 10% buffer on LYFT. Yeah, I'm all about that. I'll take that. $335 risk. Now, so we're going to save that trade, and as a bullish I'm just calling it LD as a loaded dice. Back to editor. Now, let's also, on these cheap stocks, you can only lose $1,300 on this 13 strike put. You have to, that all you're committing to do is buy it at 13. It can only go to 0. So, I mean, it's, what you can do to show the effect of that is just remove the hedge. How max loss is $2,500. Oh, because it's 2 puts. This position's only 2 puts. So it'd be like $1,300 for 1 put, 26 for 2 puts. Okay. But a person could do it this way also. You have a gigantic buffer, but you make $51, but you could easily, if something bad happened, you could easily lose a lot more. I really prefer it this way. You only make $37, but you only risk, it's more than 1/10 of what you risk. On option strat, if that's not enough, hit link legs or make sure it's selected. Okay, it is selected. And then put it in multiple times. Here's $370, risking $3,600. So just do it however many times you're comfortable with. All right, so let's look at an alternative to this one. We've already shown one for Dash, so here's one for LYFT. Let's check out CVS. They have one before the open tomorrow. Let's see what's going on with that. On CVS, we will do it in Tasty Trade. The first thing you do is go CVS, then you make sure trade, but then you have to unselect Curve. Curve is kind of like their version of option strat, and go to table. So what we want to do, the first thing we notice when we do it this way, we notice the IV over here is 112 in this week's expiration, expires in 3 days. Next week's expiration is only 65. That's because there is earnings this week. So we're gonna sell something in this week. If we're doing a calendar, we'll sell something in this week and then buy something in some other week and try to make a difference off the IV difference. But in this case, we're just going to do some kind of, let's just do something bullish in this week. So this brown thing right here, bar, that's the expected move. And that is how far the market makers are expecting the market to move by the end of the week. And that is also, it's also derived from the option volatility, 3.91 points in each direction. 3.91. So anyway, if you're wanting to sell something that's about the expected move, which is where a lot of people like to do it, and that's what I like to do, create a big buffer. So we're going to hit the left one where it says bid for the option we want to sell. We kind of have to do this ourselves here. So that brings in 88 cents, but then we want to buy something behind it to hedge. Then we can buy the 47 option for 25 cents. So we're going to click on the ask column. Okay, so right there, that's a 75% chance of profit, that spread, but it's a put spread. We're selling a 51 put and buying a 47 put to hedge it. It's 68 cents credit, or that, that's mid. It's right now, it's bid at 64, asked at 72, or the mid's at 68. So max loss is $332. All right, I'm going to keep working on this. That's not a bad start. That's not a bad start. So all right, but I'm going to make the quantity go to 2. So now it's 68, still the price that you're bidding for, but you're doing it twice. So now you're gathering $136 of premium. That's $30 of theta time decay you'd be grabbing over the next day. It's worth about 30 shares of stock, 35 shares of CVS. So you could also compare this to having 35 shares of CVS, about a 75% chance of profit. So that's not a bad trade by itself, but it doesn't have unlimited chance of upside. So what I'm going to do is I'm going to go to the expected move the other direction. And I'm going to buy one of these options. So I'll buy the 50 in case we have some kind of outlier up move. So, and we're spending about half the premium. The computer has me buying it twice. Tasty Trade does, but I need to switch that to once. It took me forever to figure out how to switch just one of them. You have to switch the other ones off and just this one on individually. Take this one down to 1. All right, so now we have a 73% chance of profit. We make $79 for the trade. We grab $5.50 of theta decay. We spend a little bit of our theta decay on this out of the money option. And now this thing, but now because of the out of the money option, this is about worth 55 shares of CVS. So we can compare it with 55 shares of CVS. Here's some metrics on it over here. Net credit. So, okay. Now, but I want to do the same trade in, or actually let's go to Curve. So they have this is their version of this big, I always call it a ghost. I guess that's the probability cone. And you can, just like on option strat, you can move from here, but it messes me up when I do it too much. I'm going to go back to where I said it. All right. And I just want to compare that to option strat. But that's, that's a pretty powerful tool to be able to do it that way. So on option strat, we'll go CVS 5147. So I bet you CVS looks good. I bet you, but I don't know. We probably should have checked here first. You can also look at option strat, but I'm a visual guy. We could have looked at the volume and the open interest, which I did not do. I probably should have. Right here, this 51 strike is, it's a wide bid ask spread. So let me just see if I can adjust it here. All right, this is similar. 52.47. I just think the 52s has a little bit more liquidity. We're going to do that twice. Then we'll add, that's a decent trade by itself. If you just want to do that, do it by itself. That's fine if you aren't wildly bullish. Oops, I messed it up. Okay, so there we have it. That's not a bad looking trade. Now, I mean, $138 credit on $862 risk, 71% chance of, profit. Break even is a 5.4%. There's a 5.4% buffer. We want that number to be as big as possible. Anyway, that's not a bad way to play CVS. I just don't know anything about CVS's earnings, but if you were bullish, that would be a way to play it. That's a bullish loaded dice, but let's look at something else real quick here. I mean, I can show the trades in Tasty Trade or Option Strat. I just think Option Strat's better for teaching, but I'll do more Tasty Trade content. Tasty Trade has some metrics that Option Strat doesn't show. Okay, so look at this. So here is another. Wonder if you're saying, "Hey, Max, I don't need all that extra upside." It's not. It's not going to go to. This is CVS. It's not going to 75. This is not Nvidia. Just chill out with all the extra upside. Well, the first thing you could do is just exclude it. And that trade by itself is a decent trade. But actually, if you're just doing that trade by itself, you could probably get yourself a little bit more buffer. And so I might slide it out a little bit further. We have to have it here to earn enough income to pay for this. This is, in my opinion, was the best available set of compromise. It was the best compromise available at the time. So anyway, but if you aren't as wildly bullish, you can either just nix that all together and maybe move the put spread a little bit further. Just sell a put spread. Nothing wrong with that. That's bread and butter. Here's another thing. You can also, instead of doing that, you can add a call. Or I'm sorry, you can add a short call somewhere. So in other words, you can make it where you cut off some of your upside on purpose, but you bring in a little bit more of a credit. Now this call is not bringing, it's only bringing in 8 or 9 cents. So it's not really doing that much. But what you can do is you can slide this one in closer. And then you can slide this one in closer too until you get a good combination of them. Sometimes it's better to go like that also. All right, that may not be that's a decent way if you aren't as wildly bullish. I'm just trying to get the best set of factors here. I think this is probably %74% chance of profit. So here's a way if you're neutral to bullish. We'll save this trade. Save as new trade. Now, all this is here is you're selling 2 put spreads to buy 1 call spread. You can mess with the ratio. We can make it, let's make it where we're only selling 1 put spread. 1 put spread to buy 1 call spread. Well, we have to mess with our strikes if we don't want risk on the upside. I don't like risk on the upside. You do something like that. Risk $390, have a 6.1% buffer on break even. The market goes nowhere, make $110 at expiration. Or if it goes nowhere, as long as it goes not down more than 4% or not up more than 6.5%, that's the sweet spot. Make $110. Max risk is $390. So that's a way to play neutral to bullish. Now let's do it this way. Let's put the risk. Let's sell calls. Let's do the reverse max. We're going to sell multiple call spreads. We'll sell 2 call spreads. And then we'll just buy 1 put spread. Something like that. So that has a 6.7% buffer. That's not a bad, I just happened upon that trade, but that's not a bad looking trade. Let me move this one in. Let me try to mess with this a little bit. $74. I mean, if you're bearish to neutral, that's not a bad looking trade right there. You just have to pick your direction. You can see these white lines are all of the strategies mixed together. The green line is the profit. Green and red line is the profit and loss of the current strategy we're on. But the white line is the other 2 strategies, the overlays. But anyway, you can see all the strategies will do well if we go nowhere. They're all designed to do all right if we're only down 4% or only up 4 or 5%. I'm calling that going nowhere. Only being down 4%, only being down 5%. Look, the break even in this case is 6%. So only being down 5%, only being up 4.3%. That's kind of what you're aiming for with these trades. All right, so we'll save this one as a neutral to bearish. All right, let's see how everything else is doing in there. So first of all, let's see how the hedge is doing right here. Bearish hedge for next week. It's down $48. That's good. That means the market's hanging in there. This hedge doesn't kick in until we get down to about 600. At 600, it'll make a couple $100. This hedge will make a couple $100. But then if we drop under 585, the protection really kicks in. So, and hopefully that's not going to happen. Hopefully that's not going to happen. I showed yesterday a February 10th loaded dice in Dash Lane. That's why I didn't show one today. It's down $132 right now. But it still has a pretty decent buffer, about a 5.3% buffer. It's about $2,100 worth of risk, $250 credit. Then in Shopify, people in Discord were saying they wanted to do something neutral, or even some people were even saying bearish. And so sure enough, I showed how to do a neutral one and a bearish one. So here was one, just a bull put spread. Let's see what this one was. Oh, yeah. I think this is one somebody from one of the rooms gave me, but that one would have worked out nice. All of the Shopify ones that were, I showed this one in Discord, a cheap bearish shot at Shopify earnings, put butterfly. That one's headed for max profit almost. I mean, not quite, we'll see. Now it has a long time to go. The problem is the market can blow up. Look, the market's, Shopify's at 120. If it's only Tuesday, the market starts going up and this thing runs out of the profit tent, that'd be very frustrating. Anyway, if you have that on, take it off. That's a winner. Any of these. Shopify plus 273. Shopify. Here's an uber bearish one. What's this one? Down 309. This is probably a reverse loaded dice, and it's just right in the middle of the big flat spot. Okay. Well, that's easy. Bearish worked on Shopify. You guys just have to tell me which way is going to work on Dash, on Lyft. And so we'll just hope the Dash does well, I guess. I mean, Uber is breaking out, and so we'll just hope Dash does well. So let's look at the market. 49 in light rain. Winter in Austin. The grass is all green, though, because we're getting tons of rain. Well, the NASDAQ was selling off last time I looked, but it's since turned around and is close to the high of the day. See what volatility's doing. It's grinding sideways. Grinding sideways on volatility. Let's see if the 10-year is still going up. See if interest rates are still on top of the Bollinger Bands. Well, they're coming down a little bit from where they were. Maybe Powell said something bullish. All right, guys. Well, I guess I'm going to let you go. I will talk to you later. All right. See you.